All right. So this is more of a beginner video. If you are aware of what market structure is, this is probably not the video for you. It wouldn't hurt to watch it again, obviously, but I want to focus this video on those that really don't know what market structure is and what this course is all about. So market structure is the foundation for everything that we're going to be doing. Okay, if you're building a house, this is the most important aspect to your house. This is the foundation of that home. You build a house on the foundation, market structure being that foundation. So understanding market structure, it is a fundamental concept in trading and investing. It provides insight into how price moves, where these potential opportunities may arise, where we can profit from them, and how we can make informed decisions in general. So an explanation to a beginner would be, market structure refers to the arrangement and organization of price movement, aka a candlestick chart like such, in a financial market. It involves analyzing the highs and lows and patterns that form over time on a price chart. So by studying market structure, we can aim to identify trends, support and resistance levels, and potential turning points in the market. So obviously there's a few different key concepts when it comes to market structure. The first being trends, which trends are the general direction in which price is moving. So as we see here, we have ourselves a high, we have a move up higher as a pullback, right? Price pulled back a little bit, making a higher low. And then you can see that price decide to come up higher, making a higher high. If this were to continue, and let's say the same exact motion were to continue, then you have another pullback, and then you have another higher high, then that's what we call an uptrending environment. Even though you have these pullbacks that exist, this is perfectly natural, okay? These two pullbacks here are perfectly natural in nature. Like, you need these pullbacks. It's almost like a reset for a continuation of the overall trend. So if you've seen a chart that looked like this, you would call that a bullish chart, right? Meaning that it's trending up. The asset is uptrending. So that's how market structure helps us. We can identify these upwards trends. So it can also be a bearish trend. So if we flip this upside down, of course, it could also be a bearish trend, right? Not necessarily upwards or downwards. It could be bearish. It could also be sideways, right? We could also have a range-bound trend where it's ranging sideways. So being able to identify the prevailing trend helps traders decide whether it makes sense to buy or sell or just stay the heck out of the market or out of the trade, right? Cancel the idea. So another key concept is support and resistance. And I'm sure you guys know what that is, right? Support and resistance is the most common thing to learn as a new trader. So these are key levels on a price chart that represent historical points where the price has paused, reversed, or changed direction. So support is a level where buying interest may emerge, preventing the price from failing further. Resistance is a level where selling pressure may increase, preventing the price from rising further. We also have swing highs and lows. Let's go back to this chart over here. So this one right here. When I was talking earlier, I mentioned you have a high, you get a pullback, which is natural, right? This is what we call a swing high, and this is what we call a swing low. A swing high and a swing low. A swing high, swing low, so on and so forth. So these are the points on the price chart where the price changed direction, creating a peak. I call them mountains, like you have these little mountain peaks here, right? Which is a swing high or a swing low. Swing highs and lows help traders identify these turning points and assess the strength of the trend. Right? We can use market structure to assess the strength of the trend. Channels. Okay, channels are another thing. I'm not a big channel guy myself, but it's still worth mentioning because others may be. You can also create channels based on these market structure points. And channels are price ranges within which the price tends to move. They consist of parallel lines connecting swing highs and swing lows. Channels can provide these trading opportunities to go from high to low, or vice versa. And identifying buying and sell zones. Now again, I don't trade channels. I'm not a channel guy myself. I threw the TV out. No more channels for me. But others may want that, so I decided to add that in. Trend lines. Here's another one, trend lines. Another key concept in market structure. Trend lines are lines drawn on a price chart, connecting swing lows and swing highs. You can draw it from this way, or you could draw it the other way. Same idea as the channel, right? And they help visualize the slope of the trend, and they can act as support and resistance levels, okay? I don't trade trend lines per se, not this way. Okay? I don't use that as support per se. But what I do is I look at it from a liquidity perspective, which you'll learn later on, okay? In the course, you'll learn that. But it's still something I have to mention because it is a key concept in market structure. The final key concept I would have to say is breakouts and pullbacks. So breakouts occur when the price moves above a resistance level or below a support level. Pullbacks, which we know as a retracement, happen when the price temporarily moves against the prevailing trend before resuming its original direction, which is what we talked about here, right? Or down here. So if we go back to the original drawing, you had a higher high, 1, 2, 3 aggressive bullish candles with 2 bearish candles. This is what we call the pullback before resuming its overall prevailing trend, which was up. So why market structure matters though? Why are you telling me all this way, Phoenix? You know, why does this matter? Well, it matters most importantly because of everything I just mentioned, right? Understanding market structure helps traders in many ways, like decision making, risk management, trade confirmation, heck, even trade identification. For example, decision making. By analyzing market structure, traders can make more informed decisions about these entry and exit points they want for a trade. They can identify levels where price may reverse or continue its trend. Risk management. Recognizing support and resistance levels allows traders to set stop loss orders and manage risk effectively, right? Without proper market structure, how would you know where to put your stop loss? You're guessing, right? At the end of the day, you're guessing, you're gambling. Obviously, this helps protect their capital in case the market moves against their position. Confirmation. Market structure can confirm or invalidate any idea that you may have, right? A breakout from a significant resistance level, for example, may confirm a bullish trade setup on a retest. Trend identification. Again, that was the fourth thing. Market structure helps traders determine the prevailing trend, as I mentioned, allowing them to align their trades with the broader market movement. So in a conclusion, market structure, as I mentioned at the beginning of this video, is a foundational concept in trading that involves analyzing price patterns, trends, support and resistance levels, and other key elements on a price chart. By understanding market structure, we can make more informed trading decisions and increase our chances of winning, okay? It's all about making money. It's all about making money. That's why we're all here, right? This is how we make money. Market structure is number one.